If you missed the deadline to elect S Corp status, you're not alone. But what if I told you the IRS actually gives you a second chance and it could save you thousands? Maybe you set up your business last year and only just heard about S Corps, or maybe your CPA didn't explain the tax advantages clearly enough. Either way, you're starting at a missed opportunity, or so you think. Today I'm going to walk you through exactly what an S Corp is, when it makes sense and when it doesn't, and the step-by-step path to filing a late election, including what the IRS actually looks for and how payroll ties into this. All right, so let's dive into it. The first question is, what is an S corporation? You might be listening to this and you're saying, Mike, I don't even know what an S corporation is. What is an S corporation? So basically an S corporation is simply just a tax election. And it's a tax election with the sole goal of saving on self-employment taxes. Now, in order to elect S Corp status, because it's a tax election, you need to have an LLC or a C Corp set up. So if you're operating your business as a sole proprietorship, you can't elect S Corp status. You can't elect S Corp status on that. But if you're operating your business as an LLC, even if it's a disregarded entity or a C Corp, you can elect S Corp status for that entity when it makes sense. And a lot of times the reason why, or the question is, why would we elect S Corp status? It's to help save in self-employment taxes. And I'll kind of give you an example to kind of show you what that self-employment tax is and how big of an impact really that self-employment tax savings can be. But once you elect to be taxed as an S corporation, basically we take the income from your business and we split it into two pieces, two buckets. You have your distributions, which is money that owners draw as distributions, money you take out of the business. And with an S Corp, you're required to pay yourself a reasonable salary. So you're going to be a W-2 employee of your business with an S corporation. You're going to pay yourself a reasonable salary, W-2 payroll for that. So we take your income, total profit, we split it into two pieces. Some you're going to take as a reasonable salary, and some you're going to take as owner's draws or distributions. And the beauty behind this is that you save self-employment taxes on the amount that you take as distributions. You're still going to pay self-employment taxes on your salary, but the amount you take as distributions, you avoid self-employment taxes on. So to help kind of drive this home or help make this easier to understand, let's go through kind of a quick example. Let's imagine that you have a sole proprietorship making $80,000 a year. If you're just a sole proprietorship, single member LLC, no S Corp status, you're going to pay $11,000, over $11,000 in self-employment tax on that $80,000 in profit from your business. Now that's self-employment tax. That $11,000 and more in self-employment taxes is over and above your regular income tax rate. So you're going to pay your normal income tax rate plus over $11,000 in self-employment taxes on just $80,000 in business profit. That's a big hit, $11,000 in self-employment taxes. But let's look at this from an S Corp standpoint. If we took that same LLC, but now we elected for that LLC to be taxed as an S corporation, remember, we're going to split your income. You're required now to take a reasonable salary. So let's say on that $80,000, we determine a reasonable salary is going to be $36,000. Now the remaining $44,000 you're just going to take as an owner's draw, owner's distribution. But if we determine that your reasonable salary, once you elect S Corp status, is going to be $36,000, you're going to have to pay FICA taxes on that. That's Social Security and Medicare, which is essentially the same thing as self-employment taxes. So you're going to pay almost $6,000 in self-employment taxes on that $36,000 salary, but you're going to avoid it on everything else. So you remember, with a sole proprietorship or a single member LLC, you're paying self-employment taxes on 100% of your income. You're paying self-employment taxes on that full $80,000. But now with an S Corp status, we're only paying self-employment taxes on the salary portion. And in this instance, in this example, on $36,000. So self-employment taxes on $80,000 versus self-employment tax on $36,000. That's the beauty behind an S corporation. Even in that simple example, making $80,000 a year, same profit, we're just choosing to be taxed as an S corporation and moving some of our money into W-2 payroll. In that example, you save over $5,000 in self-employment taxes. And the cool thing is that's year after year. You'll save $5,000 in taxes this year. You'll save $5,000 in taxes the next year, the year after that, the year after that, the year after that. That is the power behind an S corporation. Again, when you have an S corporation, it's simply a tax election. With an S corporation, you're electing for your LLC or you're electing for your corporation to be taxed as an S corporation. And with an S corporation, we're splitting our profit into two pieces. We have the salary piece, which we're going to get hit with self-employment taxes, and then we have owner's draws or distributions, which we do not get hit with self-employment taxes. And that's the beauty behind an S corporation. So you're probably asking, Well, that sounds great. So who should be an S corporation and who shouldn't be an S corporation? Well, typically we say that when does an S corp make sense for most business owners? It's once you hit about $50,000 in profit and you expect to maintain that income level or even higher in profit. And so a lot of people say, well, why $50,000? Why not $10,000? Because you're still saving money. And the main reason being is that when we elect S corp status, you now have to run payroll. You have to run payroll to yourself, real W-2 payroll to yourself. And that cost of running payroll is going to cost some money because you want to use a software. You want to make sure you're doing it right. You don't want to screw this payroll thing up. So you're going to use a software, and that software is going to have some costs to it. So you're going to have to pay for that software. That's money. You also, once you have an S corp, you have a more complex tax return. You have a business tax return. Now, everything's all going to flow through to your personal just as it did before, but you have a separate business tax return that's going to report all your business activity. And then you're going to have a K-1 from that business tax return that goes and reports it on your personal tax return, which is where you pay taxes on it. So you have a separate business tax return that's more complex and typically costs a little bit. So that $50,000 number, the reason that we say that is because you have additional costs with an S corporation. That cost is the cost of payroll. Usually say $600 a year for that. And then you have a cost for this more complex business tax return, say $1,000 to $2,000 a year for that. And so that's why we say wait until your profit hits about $50,000 or more and you expect to maintain that, because your tax savings will far outweigh any kind of cost at that point. But if you do it at a lower level, you're not necessarily going to hurt yourself. You can be an S corporation making $10,000 a year, but the costs to be an S corporation at that level are going to eat into a lot of the tax savings that you have on there. So the question says, who shouldn't be an S corporation? And there's kind of a couple main reasons where we say S corp doesn't make sense. One, if you have foreign owners, a foreign owner cannot be an owner of an S corporation, so that's an immediate out the door. There is some states or localities that S corporations sometimes may not be favorable, or maybe you just need to take a second look at. So New York City is an example. The state of Tennessee is an example. But for the vast majority of the country, S corporations make sense once you hit that $50,000 or more. And then the other instance, or maybe when you want to analyze an S corporation, is if you have a high-paying W-2 job. So let's say you're making $300,000-$400,000 in a W-2 job, or even $150,000 in a W-2 job, and then you also have this side hustle business that's starting to make $50,000, $60,000. In that instance, because your FICA taxes might be filled up by your W-2 job, we might want to just analyze to make sure the numbers make sense for the S corporation. But those are kind of the three reasons that when we say, okay, who shouldn't be an S corporation, we're typically looking at some of those instances. Now, when we talk about S corporation, there's some common pitfalls that I often see business owners run into. The first one is no LLC. You know, I talked to a business owner the other day that we talked about S corporation. They're like, oh yeah, that's great. And this was like a year ago. They're like, oh yeah, that's great. I love this idea. But you know, I don't have an LLC set up. I'll work on that. Well, as business owners do, they get busy and they didn't work on getting that LLC set up. And so what actually happened is they were continuing to run as a sole proprietorship, no LLC, no entity structure, and they signed a big contract in October. And they came to me and they said, Mike, I want to do that S corporation now. And I said, well, great. Like, you have your LLC set up, right? So we can do a late election on the S corp. And they said, yeah, I didn't set up the LLC yet. I said, okay, well, there's nothing that we can do with that income that you have up until this point. Now, we can start an LLC today and do an S corporation election moving forward, but there's nothing we can do going backwards since you did not have that LLC set up. If you had that LLC set up, now we have power for it. So common pitfall we see is people not doing and having an LLC set up. And so I often advise business owners, at least at the beginning, to have an LLC, start an LLC, get an LLC set up so that it opens up the door for an S corp election when it makes sense. Now, just going from a sole prop to an LLC with no S corp election, there's no tax savings there. There's some, as an attorney will tell you, there's some liability protection opportunities there, but there's no tax savings there. But the LLC kind of serves as like an insurance policy. The insurance policy is say, hey, once my income hits a certain amount, because I have this LLC set up, now I can do the S corp election. Another common pitfall we see is premature elections. People going to the S corp too quick. You know, they might have started a business, they started an LLC, and they just elect S corp status right away. And that business is losing money. You know, in startup mode, they're losing money. They're not showing a profit yet. Well, that person, that business, they could have waited to do that S corporation until they started to generate that money that made sense. Now they're doing payroll, extra tax returns that might be unnecessary. So oftentimes we see people making premature elections, jumping into the S corporation before it is actually necessary. So make sure you're thinking about that. We also see a big pitfall with an S corporation is people underpaying or overpaying a reasonable salary. Remember, with an S corporation, the IRS requires you to take a reasonable salary. That is a key point, because otherwise, if you look back at my example before, someone might say, hey, I have $80,000 in profit. Why don't I just take $1,000 in reasonable salary, and I'm only going to pay self-employment taxes on $1,000 and avoid it on $79,000? Well, we can't do that, because the IRS says you have to be taking a reasonable salary based on the work that you're doing in your business. So it's important that we're taking that reasonable salary, but we also want to make sure we're not taking too much, because if we take too much of a salary, the IRS isn't going to care, because you're paying them plenty of taxes, but you're paying way more in taxes, self-employment taxes specifically, than you actually need to. So that's another common pitfall, is just getting that salary right. Getting that salary right that's not too much, it's not too little, it's right perfect as a reasonable salary. And we help people all the time at TaxHome with that analysis and determining kind of what that reasonable salary would be. Now, we're talking a lot about this S corporation. How do we do it? What does that look like? What's the deadline to do that? And that's the big problem that we're talking about today. Folks that missed the election deadline. So in order to elect to be taxed as an S corporation, you just file a form with the IRS. You file Form 2553. Now that form must be filed within 2 months and 15 days from the effective date. So let's say you wanted this effective on January 1st of 2025. You would have needed to file that by 2 months and 15 days after January 1st of 2025. Now, if you're sitting here watching, listening to this right now, we're way past that date. And so that's a problem, because no longer can we file this, right? That causes a lot of confusion. That's caused a lot of people they're not ready for it yet. They haven't been ready for it. Maybe their business grew and they had this big boom in growth in June. They didn't need an S corporation in February, but they need it now. How do we go back and do that? And fortunately, what most business owners don't realize is that the IRS allows late relief. And after doing this for over 15 years, we see this loophole being used on a weekly basis. And usually it always gets approved if it's done correctly and if it's done right. So big thing is Form 2553 is the form that you file to elect S Corp status. And that form must be filed with the IRS within 2 months and 15 days from the date that you want to be effectively known as an S corporation. But the IRS offers late relief. So if you're listening to this now saying, hey, I love to be an S corporation, I want to see those self-employment taxes for 2025, but I missed that deadline. Well, the good news is you can go back and do it. And we're going to talk about what those steps are. What do you need to do that late election, so that we can here in 2025, we can backdate that election to January 1st, so that this full year of 2025, we can be treated as an S corporation due to this relief that the IRS gives us. Now, real quick, if you're looking for tax strategies that you can actually implement, I built a software called TaxHome, where we don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with step-by-step guidance and full implementation help alongside you. If you're serious about paying the least amount of taxes legally possible this year, click the link in the description and book a free discovery call with our team. All right, now back to the S Corp late election. So that's the problem, is that deadline is two months and 15 days. So what's the solution? We file a late S Corp election. So if you miss that 2 months, 15 days, no problem. All we gotta do is a late election. A few more steps, but this is something I would say probably I've done thousands of S Corp elections over my career, and I would say probably over 80% of them are late elections, because it only comes up after the fact where people start to listen to this and they don't do it on time, so we file a late action. So how do we file that late S Corp election? You're gonna use that same form. Form 2553. We're filing using that same exact form, but here's what we're doing different. On the top of page 1 on Form 2553, you're going to write on top of it, just right in there, right in the top part of that form, filed pursuant to Rev Proc 2013-30. That's it. So take out Form 2553, print it out right on top. Filed pursuant to Rev Proc 2013-30. Then you're going to fill out all the information that you don't normally fill out in that Form 2553, but you're also going to fill out Section I. And then that's going to be your reason for that late election. Why is this election late? And the IRS just wants you to give an explanation of why it wasn't filed on time. Some ideas for this you could write, obviously doctor this up a little bit, but something about like I relied on a tax pro that didn't end up doing it, or I was unaware of the filing requirement, or there was some type of misunderstanding on the deadline or something like that. Either way, we just need a reason to put in here in the section I of Form 2553 that you can fill out to say why this form has been elected late. So let's go through an example. Let's say that it's June 2025 and you wanted an S Corp election effective January 1st of 2025. You're now late, obviously, so you can file Form 2553 using a late election, and your effective date on that Form 2553 is going to be January 1st of 2025. You're going to write the RevProc ruling on top of it, and you're going to fill out section I. That's it. You're going to mail that Form 2553 in. I also advise faxing it. What I always do with these things is I mail them in, and I also fax it in and say, hey, okay, one of those two hopefully hits an IRS office desk and they can process this form. So mail it in and fax it in, do whatever you need to do that. That's it. That's as easy as it is. And again, if the IRS denies it, make sure when you get that acceptance letter, it's the right date, it's the right effective date. And if they deny it, they kick it back, just provide whatever they need to get to that. If you're a member of TaxHelm, send us that form before you mail it in, fax it in, send us that form. We'll review it for you and say, hey, yeah, this looks good. Go ahead and send it off now. That's the late election. So essentially that allows you to say, hey, that 2 month and 15 day, personally, as a tax professional, I never even think about that 2 month, 15 day, because I know that I can do a late election and I know how easy it is to get these accepted as long as that form is filled out correctly. Now, the number one mistake we go from here then is that how does payroll fit into this? You know, most business owners, or a lot of business owners who elect a late election, they skip that backdating payroll piece. So remember, if we backdate that election, let's say we're doing that June as an example. In June, you decide, yes, I want to be an S Corporation. We're going to backdate it to January 1st. Well, if you backdate it to January 1st, that means that you are an S Corporation from January through December. And that means that your reasonable salary, that reasonable salary you take, has to be from January through December. Even though it's only June and you're just now deciding to do this, you need to make sure that you have a reasonable salary for that full year if you decide to file that late election. So what do we need to do? We need to run payroll. And a lot of times people do payroll on a monthly basis, on a bi-weekly basis. They just put it on. If you have other employees, just put it on that schedule. You get to determine how you do it. But what we see a lot of people do is we pick a nominal amount to say, okay, here's kind of where we'd expect our payroll to be. But sometimes we go a little bit lower. And at the end of the year, we'll just true it up. So let's say we ran $50,000 in payroll, but at the end of the year we determined it should be 60. Well, we'll just kind of run a payroll where we just pay the taxes on the remaining $10,000 at the end of the year when that happens. But the key thing is that you need, once you're an S Corporation, you need to take a reasonable salary. That is a requirement of the S Corporation. So that is a key thing. And just remember that you might need to backdate some payroll, especially if you're just doing this now, a late election, you're doing this in June, but it needs to be effective for January 1st. You need to make sure that your payroll total at the end of the year is enough that covers a reasonable salary for that full year, even though you didn't actually submit that election until June, because you made it effective January 1st, which is the beginning of the year. So just something to think about there. You know, compliance with an S Corporation is important. That's what helps protect the S Corp election from being rejected. That's what helps protect you from being audited, is just simple compliance. And so what does that compliance mean? You file the form correctly, you file Form 2553 correctly, and you act and live and breathe like an S Corporation. What does that mean? You pay yourself a reasonable salary as the owner of that S Corporation. So hopefully that helped make sense. Hopefully that eased some concerns you have if maybe you're like, oh, I missed the S Corp deadline. Well, guess what? There's still time. And again, let's kind of just recap shortly. What is the power behind an S Corporation? An S Corporation is simply a tool to help lower the amount that you're paying in self-employment taxes. If you're set up as a sole prop single member LLC with no S Corp election, you pay your normal income tax rate on the profit of your business, plus you pay self-employment taxes of 15.3% on 100% of the profit of your business. If we take that same entity and elect for it to be taxed as an S Corporation, we take your income and split it into two pieces, a salary piece and a distribution piece. The reasonable salary piece, we're going to pay self-employment taxes on that, but we avoid it on the distribution piece. So I gave kind of an example. You have a company making $80,000 a year. With no S Corporation, they're going to pay self-employment taxes of over $11,000 in addition to their regular ordinary income tax rate. But if we take that same business making $80,000 a year and we elect S Corp status, and let's say we determine a reasonable salary is $36,000, instead of paying $11,000 in self-employment taxes, we're only paying $6,000 in self-employment. That's over $5,000 in self-employment tax savings every single year by simply making that tax election. What's the biggest part of that? One, we need to take a reasonable salary, and two, we have a little bit more complex of a business tax return. And so that's why we say, when does it make sense to do an S corporation? Generally stating, once you hit about $50,000 or more in profit is when it starts to make sense. Now, that S Corp election has to be filed within 2 months and 15 days of the effective date. If you don't do that, no problem. That's where we do that late election. We file Form 2553 to do that election. We're going to write on the top of that Form 2553, filed pursuant to Rev Proc 2013-30, and then we need to fill out Section I, along with all the other items in there, but we need to fill out Section I specifically for a late election, explaining why it is a late election. That's it. And then remember in the back end that you need to run payroll. You need to run payroll to do that. One final thing also is that remember, in order to elect S Corp status, you have to have an LLC or a corporation set up. So if you're thinking, hey, this S Corp sounds good, that self-employment tax savings sounds good, but you're still operating as a sole proprietorship, forget about the S Corp right now. Go get an LLC set up. Start to organize and run your business under an LLC. And then once time makes sense, then we can elect S Corp status. But if you don't have that LLC set up, there is nothing we can do from an S Corp standpoint. Have that LLC set up, even if you're not ready for S Corp yet. Great. Have that LLC set up, run as an LLC, and then just know that it's sitting there waiting for you, ready for you, that you can elect S Corp status now when the time does make sense. So yes, you can still elect S Corp status late, and if you do it right, the tax savings and legal protections are just as powerful. If you found this helpful, don't forget to subscribe, like, and share it with a business owner who's panicking about their missed deadline. And if you want help navigating your own S Corp election or back pay setup, visit www.taxhelm.com or click the link in the description for a free discovery call. We've walked dozens of clients through this successfully, and you can be our next one. Thank you for listening, and I will see you on the next one.